The 1990s were an era of innovation and confidence on Wall Street. New financial products, global capital flows, and cutting-edge mathematics convinced many that markets had entered a safer, more predictable age. At the center of this optimism was a hedge fund called Long-Term Capital Management, or LTCM. Founded in 1994 by John Meriwether, a former Salomon Brothers trader, LTCM assembled a team that seemed unbeatable. Its partners included Nobel Prize-winning economists Myron Scholes and Robert Merton, whose work on option pricing had revolutionized modern finance. The fund promised to harness advanced mathematical models, deep market expertise, and sophisticated leverage to deliver high, consistent returns. For a time, it worked brilliantly. LTCM employed relative value arbitrage strategies, betting that price differences in similar securities would eventually converge. The positions were small in theory, but the fund magnified them with extraordinary leverage, sometimes borrowing over $25 for every dollar of capital. In its early years, LTCM produced annual returns of more than 40%. Wall Street envied its brilliance, and investors clamored to get in. But financial history teaches that when something looks too good to be true, it usually is. By the late 1990s, cracks in the strategy began to show. LTCM's models assumed that markets were rational and that spreads would eventually revert to normal. What they underestimated was the power of real-world shocks. In 1997, the Asian financial crisis shook markets across the Pacific. Currencies collapsed, stock markets plunged, and investors fled to safety. LTCM survived, but volatility was rising. Then, in 1998, a far bigger storm hit. Russia, facing unsustainable debt and political turmoil, defaulted on its government bonds. Investors panicked, selling risky assets and rushing into U.S. treasuries. For LTCM, this was catastrophic. The spreads they had bet on widened instead of narrowing. Safe assets rose while risky ones collapsed, the exact opposite of what their models predicted. Because of their massive leverage, even small losses snowballed into devastating hits. At its peak, LTCM controlled more than $125 billion in assets, with just $4 billion in capital, plus over $1 trillion in derivative exposure. When the tide turned, the numbers were staggering. By late summer 1998, LTCM was bleeding billions. The fund lost almost half its capital in a matter of weeks. Its positions were so large and so intertwined with global markets that a collapse threatened to trigger a chain reaction across Wall Street. Major banks, brokerages, and counterparties were exposed. Fear spread that if LTCM went under, it would take much of the financial system with it. The Federal Reserve realized the danger. In September 1998, the New York Fed summoned Wall Street's biggest banks to an emergency meeting. The result was a coordinated $3.6 billion bailout funded by 14 major financial institutions. LTCM's partners were forced out, and the fund was gradually wound down under supervision. The rescue prevented an immediate meltdown, but the lesson was clear. Even the smartest minds in finance could nearly bring down the system. The LTCM debacle raised fundamental questions about risk, leverage, and the limits of mathematical models. Scholes and Merton had developed brilliant theories, but they could not account for extreme events, what traders call fat tails. Markets can stay irrational longer than models assume, and rare shocks can wipe out years of steady gains in an instant. Wall Street learned that excessive leverage magnifies fragility. LTCM's trades were not unusual in themselves, but by scaling them up to astronomical size, the fund created systemic risk. The idea that a single hedge fund could threaten global stability stunned regulators and investors alike. In response, regulators pushed for greater oversight of hedge funds and derivatives markets. While the reforms were modest, LTCM's collapse became a case study in financial fragility. A decade later, when the 2008 crisis erupted, many pointed back to LTCM as an early warning. The same themes, excessive leverage, blind faith in models, and interconnectedness, were on display once again. For the partners of LTCM, the collapse was a personal and professional humiliation. Once celebrated as the brightest minds in finance, they became symbols of hubris. Investors lost billions. For Wall Street, it was a sobering reminder that no one is too smart to fail. The story of LTCM remains relevant today. In a world of complex financial products, rapid trading, and global capital flows, the temptation to believe in flawless models is ever present. But markets are driven by human fear and greed as much as by equations. The collapse of LTCM shows that when leverage meets uncertainty, disaster can follow. In the end, LTCM's fall was not just a hedge fund's failure. It was a moment that exposed the fragility of modern finance. Wall Street was shaken, the Federal Reserve was forced to act, and the world was reminded that risk can never be eliminated, only managed. The lesson is timeless. Humility in the face of uncertainty is the most valuable asset any investor can hold.